Jingay Nograles with BPI Asset Management, and here with us today is Sem Velmayor, ALFM Dollar Bond Fund's Fund Manager. The fund has actually been consistently outperforming its benchmark so far this year, already posting 3.84% gains year to date. So Sem, what are your views on U.S. interest rates given the outcome of last week's FOMC meeting?
We see global interest rates rising for the rest of the year and possibly well into 2015. As for the 10-year U.S. Treasury, is probably around 2.6% as of today and will probably rise to close to 3% by the end of the year.
How about Janet Yellen's comments about keeping interest rates lower for longer? How do you see markets reacting to that? Honestly, it's been quite a confusing time for fund managers as there has been relatively no volatility for the year so far. Plus, the US dollar has actually weakened despite the Fed's comments about the greater prospect of higher interest rates for the year. Do you see this continuing for the second half? And more importantly, when are we going to see more volatility in the market?
The Federal Reserve has actually been quite transparent in some ways on what it plans to do moving forward, such as the reduction in monetary stimulus by reducing it by $10 billion per month. And they've kept to that program so far. They're now down to $35 billion per this month. They've also been quite vocal on what factors they were focusing on before making any more monetary policy changes, such as the US employment figure and their targeted inflation figure. For the rest of the year, we expect the Fed to continue to provide forward guidance to avoid any unwarranted volatility in the bond markets.
As I mentioned earlier, the ALFM Dollar Bond Fund has been consistently beating its benchmark so far this year. Would you mind giving us some insights on what helped you outperform your benchmark, as well as how your strategy is going to be evolving with Janet Yellen's comments?
We reduced the fund's duration and consequently the volatility of the fund by staying away from the long end of the yield curve. We have likewise diversified into non-Philippine risk assets to reduce concentration risk. Since it seems that the rise in interest rates will be a long drawn-out affair, we could take a slightly more bullish stance on bond purchases. In this sense, we could possibly take a little bit of more duration for the bonds portfolio.
Heading into the second half of 2014 as well as the first half of next year, could you possibly see some events that could pose some downward risk to ALFM Dollar Bond Fund's portfolio?
Some things to consider are if the markets would overreact in the same way as they did last year. If you remember, sometime in May, the Fed introduced the idea of reducing their quantitative easing program, and just the talk of the tapering actually had the market spooked, and they started to sell off in the financial markets.
Finally, I recognize that you might not be able to provide your yield targets for the remainder of the year, but would it be fair to surmise that if volatility were to remain where it is today, which basically is non-existent, then the ALFM Dollar Bond Fund should be able to continue to provide positive returns?
Although we think we would be facing more challenges for the rest of the year, the fund will continue to be flexible so as to be able to adapt to the changing market conditions and optimize returns. Barring any unforeseen event, the fund should continue to provide positive returns.